Welcome everybody. We will start the webinar in just 2 more minutes, allowing time for more people to join. Hello, I'm Andy Hill, Deputy Head of Market Practice and Regulatory Policy at ICMA. Welcome to this special live ICMA webinar on T+1, state of play and bond market implications. This is intended to be first in a series of webinars focusing on different aspects of the topic, reflecting the various perspectives and considerations of a range of stakeholders. Much has been written and spoken about the pending move in the US and a number of other territories to reduce the time between trade date and settlement date to a single day, as well as the likelihood that many other jurisdictions will feel compelled to follow. The narrative has mostly focused on the reduction of counterparty and credit risks and potential efficiency gains, particularly in the case of exchange-traded or centrally cleared instruments, as well as the logistical challenges and associated costs of modifying often complex post-trade processes that can involve numerous entities and spanning multiple time zones. However, one of the considerations of shortening settlement cycles, in fact, some would argue the most important consideration, is what does this mean for trading? How will it impact pricing and liquidity, particularly with respect to instruments that are very much dependent on market makers or other principal intermediaries to support secondary market activity, such as bonds? To what extent will a shortened settlement cycle add to their risk and the cost of doing business? And how will this change behavior and the provision and price of liquidity? To answer these questions, we are extremely privileged to be joined by 3 market experts who are very much focused on the trading implications of the move to T+1. But first, I will hand over to my colleague, Alexander Westphal, who will provide a brief overview of the current state of play in order to set the scene for the panel. Note that this webinar will run for approximately 1 hour. It is being recorded and will be available on ICMA's website if you'd like to re-experience it or share it with colleagues. For the entirety of the webinar, your line will be on mute. But if you have a question, we'd love to hear from you. You can submit your question using the Q&A box, which is in the toolbar at the foot of the screen. We'll aim to answer it following the panel discussion. Alex, over to you.
Thank you very much, Andy, and hello, everyone. I'm Alex Westphal. I'm a Senior Director here at ICMA, and I am coordinating our repo and collateral work. One of the important topics, of course, at the moment is T+1. Before we go into the certainly interesting panel discussion, I wanted to just provide a bit of background to the T+1 discussion, to summarize briefly where we come from and where we are in the current discussion, and also why this is such a hot topic at the moment. So to start, I prepared a little timeline to show some key milestones of the T+1 discussion. So let me bring that up. There we go. I hope you can all see my screen. So this is focusing on the US at the bottom and Europe on top, separately for the UK and the EU. Now, noting, of course, that the idea to shorten settlement cycles is not new. This didn't start in 2022. We've seen a gradual shortening over the years to currently T+2, so settlement 2 days after trade date. The move from T+3 to T+2 in Europe happened in 2014 and in the US in 2017. And since then, there has been some talk of further shortening to T+1. In the US, this received a lot of momentum with the GameStop events in 2021, which resulted in a push by regulators for T+1, which was seen as a way to reduce counterparty credit risk in the system and related margin requirements. So the SEC proposal to move to T+1 was then published in February 2022, followed by the final rule in February 2023, which also specified the timeline, setting the go-live date to the 28th of May 2024. So that's less than a month away now. And subsequently, we've also seen Canada, Mexico, and Argentina who decided to align with the US and will move on the same weekend. So it took some time for this discussion to reach Europe, but it has now certainly fully spilled over. That started in the UK, which took a more proactive approach on this topic. So in December 2023, as part of the Edinburgh reforms, the UK Treasury announced the launch of an industry task force, the Accelerated Settlement Task Force, to explore the benefits of T+1 for the UK. Charlie Geffen was appointed as independent chair of that group, and ICMA has been a member of the group ever since. So that task force was asked to prepare an interim report by the end of 2023, and then a report with final recommendations by the end of this year, so end of 2024. And that interim report, the so-called Geffen report, was then published with a few months delay in March 2024. So that is now publicly available, and the recommendations have been endorsed by the government. And I'll go a little bit more into the details there in a minute. But first to say, on the EU side, the discussion has been a little bit more cautious, but ESMA was given a mandate in the CSDR review, so in CSDR refit, to prepare a report for the European Commission to assess the need and also the impact of T+1 in the EU, including explicitly a cost-benefit analysis. And as a first step in that process, ESMA issued a call for evidence consultation last October, to which we obviously responded through our ICMA T+1 task force. And now ESMA is essentially reviewing the feedback to that consultation, and they're due to publish their final report later this year. We currently expect this for the third quarter. But what they have already released is a statement to essentially summarize the feedback that they received, which was, to be fair, very mixed. Most stakeholders highlighted the enormous challenges with T+1 in the EU, pointing, among other things, to the much more complex and fragmented market setup in the EU compared to the US and also the UK. But it's important to note that the discussion since then has taken on a slightly more political dimension. Back in January, the European Commission hosted a roundtable in Brussels, where they delivered a fairly strong message on T+1, stating that T+1 in the EU is not a question of how and when. Sorry, it's a question of how and when and not if. and they were quite keen to focus on practical solutions rather than costs and challenges. Of course, that doesn't mean that a formal decision has been taken, which will also have to go through the regular and quite lengthy political process in Brussels. So the discussion is very much continues, and we're all waiting now for the final ESMA report. So just to go a little bit more into the details of the discussion so far, starting with the UK, as mentioned, the Geffen report was published on the 28th of March, and here some of the key recommendations listed. Certainly most important is that the report recommends that the UK should commit to T+1. There's been quite a lot of discussion around the timeline. The final report suggests a move on a date in 2027. So that's already more realistic than dates that have been floated before. Importantly, besides the move itself, the report also suggests mandating certain operational requirements, and that would happen as early as 2025. So that's to keep in mind, and that would include rules related to the allocation, confirmation, matching, and instruction process. So for all of those to happen on trade date. There's also been an important discussion on scope. Initially, the suggestion was for a very broad scope of any UK T+1 requirement, but the final report suggests now limiting the scope to securities that are actually traded on a UK trading venue and also settled on a UK CSD. And that's important because many UK corporate bonds are in fact issued in the ICSD, so outside of the UK. And an overlap there would certainly create a lot of complications and potential fragmentation of liquidity. And that overall shows also the importance of close coordination with the EU, which is something that is also acknowledged in the report. And then finally, very positive, the recommendations are not set in stone, but are subject to further discussion in a technical group of market practitioners, which was set up to validate and further specify the various points. And that work has now kicked off and has been really constructive so far. There's a steering committee that meets on a weekly basis, which we're part of, and a number of subgroups that have been established to cover the main issues, including trading and liquidity, which obviously is our focus today. And then just a final slide before handing over to the panel. On the EU side, I already mentioned the process, but it's also important to note that we established a cross-industry task force with 15 other trade associations with the idea to really coordinate the T+1 work. And that has already been quite useful in coordinating input to the ESMA consultation. And now we're in the second phase of that work. The deliverables are still to be fully defined, but it's certainly a great opportunity to develop a better understanding for the key challenges and potential solutions across the different key areas. Again, listed here, two of which we are actually co-leading at ICMA, the workstream on trading and also on securities finance. And it's also a great opportunity for members to get involved, either directly in those groups or indeed in our ICMA T+1 task force. So please don't hesitate to reach out to Nina and myself. The email details are here on the slide. So with that, I hand over to my colleague Nina and our esteemed panelists for today for a very interesting panel discussion. Nina, over to you.
Thank you very much, Alex, for this very comprehensive overview. And yes, to the audience, if you have any questions also for Alex and his presentation, please feel free to reach out to us via the Q&A box and address. So my name is Nina Suher-Wolf. I'm a director at ICMA, and I will be now moderating our panel discussion on T+1 trading and liquidity implications. So first of all, I would like to express a very warm welcome to our panelists for today. Stefan Malret, Global Head of Market Structure and Innovation for Financial Markets at ING. Welcome, Stefan. Hello.
Thank you. Hi, Nina.
Also, hello. Also, we have Thomas Hansen, Head of Short-Term Markets at Santander. Hi, Thomas. And also Matthew Coop, Global Head of Cross-Market Asset Structure at Barclays. Hi, Matt.
Hey, Nina. Thanks for having me.
So as we have just heard from Alex, we are only 1 month away now from the US and North America moving to T+1. So my first question for today would go out to Stefan. Stefan, with the US move now being imminent, how ready do you think are we for this major transition, and what are the key impacts you are expecting?
Yes, thank you, Nina. Hi, everyone. I think you are ready as an industry. We're ready as much as we can be. From a technical point of view, people have been developing and preparing for the US move for more than a year now, and there have been different testing activity to make sure everything was fine. So I think from this point, it should be okay. The concern are more on all the other parts, trying to understand how the market will evolve in terms of different processes who are manual today, who either need to change in terms of time frame during the day or to be more automated. This has never been tested before, so we'll have to be a wait and see on the go live date. So I expect the first week to be a bit of a lesson to be learned with a lot of questions. And also I expect that over time we'll see a different level of preparation for people. If you're based in the US and you trade US stock and US bond, you're probably very close to what the implementation will be. But if you are based in Europe, you may still have some uncertainty on what type of bonds are going to still settle T+2 versus the type of bond will settle T+1. And if you are based in Asia, I think what I get as a feedback, a lot of Asian investors are even not aware of the change. So we'll probably discover that on the go live. And this is probably the part where is more cumbersome, because for them, the interaction or workflow in terms of their FX settlements or on the different other aspects of the workflow will be a big impact, because their short time window of operation will be very, very short. So impact, small in the US, medium in Europe, and probably much larger in Asia.
Thank you very much, Stefan, for these very valid considerations. And we can see indeed that there are different aspects to look out for, and that the move has implications for bond market participants worldwide. So, Matt, what are your thoughts? Are these issues to solve mostly for the operations departments, or are there also some bigger issues from a front office perspective?
I think that's a very valid question, Nina. And critically, the way that generally most people probably have answered the problem is, oh, it's post-trade. It's just down to ops. Once I've done the trade, I pass it down, and it's for them to sort out that it's settling. When I first joined the city, a little bit of a long time ago now, but someone told me a very good saying: a trade's not done till it's done, and we need to make sure trades are done. And if it's not done in front office, it will impact us. So to me, it definitely does impact trading. Critically, when you're looking at T+1 and when you're looking at any kind of market structure change, I'm quite a simple individual, and I very much like to sort of break things down step by step so I can really get to understand things. And in T+1 is no different. If we start looking at the trade life cycle, let's start with the buy side. I think this is the critical point, right? So to do a trade, to acquire a security, I need some money. That generally requires an inflow of money from funds. Now, that fund settlement cycle at the moment generally operates on a T+2 basis, but even in some cases goes out to T+5. Now, if an individual is putting money in the fund, they expect that to be invested straight away generally. And so there's a big question here that needs to start off at the start of the investment and the trading process in terms of what do I need to do? How can I get this money? So that is one point there in terms of, do I need to fund this trade? how do I actually get that trade done? Do I need to extend settlement? I think there's a lot of conversation that needs to happen there. And also, how does that then interact in the execution process of the trade? Critically, the next step then is obviously when I'm trading a security, I need the actual security. It is there. So one, there's two elements to that. If someone is going short on a product, that means they're going to have to get that security to deliver it for settlement a day earlier than quicker, right? So essentially they need to get it on T, trade of the trade date. So there is going to be a stronger demand, a stronger focus on inventory control and everything around that. The other element as well is also fits into the sec lending point, and I don't want to get in front of Thomas's point a bit, but the key point here is actually, can I get the security back from the sec lending environment to make sure if I've sold that asset, I can actually deliver for when I've done the sell. The other part as well also comes back to cash. And, as Stefan mentioned previously, is when you start looking at the FX part, we're now compressing the trading side of it, and a large number of global funds will trade in an asset class that might not be US dollars. So I might need to acquire Swedish krona to then be able to buy a piece of US credit. How do I do that? Because normally today, generally people probably might leave it an extra day to make sure that, I've got T+2, so I can trade the next day, manage my FX, know what my position is for the fund. Again, alongside that, when you're looking at FX, you don't want to trade multiple times. You want to be able to do one trade in block to make it efficient, to ensure that you can get an effective best execution process and manage a good buying power. So again, FX becomes a key point to it. There's lots of different things that impact FX as well from an operational perspective in terms of timings and when that works with CLS, which has been well documented. And I don't pretend to go down that rabbit hole on this call. So I think there is a lot to talk about with T+1. Critically for me, when I'm looking at it through a buy-side lens, everything seems to come down to best execution. Because when you look at the transactional process, there's always something that's going to potentially come along which might add an additional cost. It might take away additional cost. And critically, that is all about best X and thinking about how am I optimally executing this trade.
Yeah, and if I may add to Matt's point, a very good point. It started as an operation challenge, and people thought, how do I make sure I have the right processes in place from an operation point of view? But as Matt said, it's going to impact the front office and the middle office for the allocation process, the confirmation process, and not only in the securities world, but in the FX world and on the repo world potentially. And I think this is where people start to wake up to say, how can I change my processes to be able to do that? If I use the FX example, if I buy bonds in the US, settle in the US, I may need to have US dollar, and so I will have to do my FX component. I can do it in a different way. I can either pre-fund the estimate amount that I need, or I can try to do it at the end of the day, but then there is a problem of liquidity. What is the impact on liquidity on the other asset class that, or what costs if liquidity is poor, I'm going to have a larger spread. And when we discuss with our clients, buy-side clients, what we realize is that there's still many questions from the buy side to understand what change of processes they need to do to be able to adapt the different workflows that need to be changed. And they are looking to the sell side to say, what are you going to offer to me? Can you open your trading activity later in the day? Can you give me more liquidity during US late hours of the day? And the sell side are waiting for the buy side to say, well, no, in fact, we expect you to try to pre-fund your activity. And until this is resolved from both sides, it's very hard to estimate the size of the impact of the change we are going to be needed post go live. So that's why I think the first week is going to be quite important to understand which clients is going to change their processes in which way, or which liquidity manager banks will adapt to their client needs.
And I think, if I may, and I totally agree with that, Stefan, just looking at your FX point, one key area is, from 4 o'clock EST on a Friday, There's no systematic liquidity because all the trading venues are shut. There's no streaming FX flows. So how's that going to work? And again, I think it critically comes to the buy side to reach out to the sell side to ask the question, what are you going to provide me? And then a well-informed sell side definitely will have the right place to be able to answer those questions in terms of how that comes together to make sure you can support your client.
Yeah.
Just one other small point, which goes back to the internationality of this, is there's some best practice that's recently come out, which I urge all industry participants to look at, because the initial regulatory scope of T+1 is to focus on US ISINs from a US issuer in US dollars. Best practice now, that scope has dramatically increased to include a lot more of international products. And so you'll find DTCC defaulting to T+1, and you'll also find venues defaulting that settlement to T1 as well. So critically, there are key questions that need to be looked at from the sell side and also a buy side perspective there.
Thank you very much, Matt and Stefan. Yeah, and for highlighting also that it's definitely worth for all market participants to take a look at the ICMA guidance and how this translates to all the different transactions you are conducting. So having looked at a few implications now on the bond side and FX side, there's no doubt, and Matthew has also alluded to it, that repo and securities financing markets are very critical to the whole T+1 discussion. So my next question is going out to Thomas. What are the main impacts you are expecting on the repo side in connection with the US move to T+1?
It's going to be a lesson for repo and securities finance people, because if you ask the repo traders, they will say, well, it doesn't matter, it's just another value date, which from the traders of repo books is absolutely true. They get their maturity ladder and they manage it on the days that they need to manage it. But away from that, there's a lot of other actors in the repo market and the securities finance market and sec lending market, which very often today do not actually book trades until on the day, because they need to move collateral around in the absence of having the cash. This means that they utilize pieces of collateral which otherwise would just sit there, and often called free collateral in certain institutions, to manage these intraday liquidity needs. If you need to move securities from one location to another, it needs to be booked on the day, and you need to make sure that those securities actually can be moved in the ICSD or the CSD, so they need to be paid up securities already. If you need to move them into another entity where you need to collateral to release collateral, that needs to go to somewhere else. So it's a logistics issue. This logistics issue is easy to solve when everything is booked for T1 or T+2. But when it's today and it all needs to happen sequentially, there are issues in terms of what happens first. There can be some transactions which are DVP, so delivery versus payment. That means you just need to have the cash available, so you just need to have enough cash buffers. If it's delivery of value versus value, if the other value, security, is not available, you will not get back the one you need to deliver to somebody else. If those types of transactions are as integrated as they are today, it is going to be somewhat challenging to predict what is going to happen in the US with certainty, because we have no metrics that we can say that indicates whether or not it's all working fine in the morning. The only thing we can see is the number of fails. I would expect there to be, not because people want to, but be quite a large number of fails in any type of security, because the government securities, which are cash substitutes, can be moved fairly easily, but they're often pivot points for lots of other asset classes. So those securities that a fund might have been selling, the agency lenders might have lent out, and the people they've lent it out to cannot return them because they have used them somewhere else, and to get them back, they need to deliver these government securities. That chain could be very, very long. So I think we will be all right in the end, but there will be a lot of friction because we are taking something that is by nature, because it happens and gets booked on the day, is sequential, and we're trying to shorten that or compress that sequence down to a much narrower space. That's the crew of it. I don't think it's more complicated than that in terms of identifying what the actual problem is, but out of that sequence of things that happens are so many different things, which on the buy side is very different in nature to what it is on the sell side. There's lots of vendors that needs to solve for certain things. There's that whole cycle from when the trade has been executed in cash to when it actually settles, where there's different kinds of reporting that needs to happen from a regulatory point of view. There's allocations of trades. Then there is where do they actually sit, with what custodian, what did the custodian did with them, what chain are they in? All that is just being compressed. There's a lot of things to solve for in terms of logistics. I think what you will see is that people will realize they need to pre-fund a lot of stuff in the first period of time to alleviate those fails until they feel confident enough that their processes are fast enough to not engineer these fails or faults.
Thank you very much.
The
Sorry,
key
Matt.
point I'd add to that, the key point I'd add to that, when you start looking at pre-funding from a buy-side perspective, that is obviously wrapping up cash within the fund. It's not been allocated elsewhere. So the key element there is then to check the performance drag that might have, and to make sure on top of that in terms of how that works through. So again, I totally echo Thomas's sentiment in terms of this is going to play out over time, and we will gradually see the friction, the sand in terms of what the impact is.
Thank you very much, Matt, and also Thomas. So it will be very interesting for us to see how the first weeks and months will pan out after the US move to T+1. So triggered by the US move, of course, there are discussions about moving to T+1, of course, going on in other jurisdictions as well, such as the EU and UK. So I would like to ask Stefan, where do you see main impacts here from a front office perspective, and how are they perhaps different to those described in the context of the US move?
Yes, and let's start with the good news. In a way, that the US goes first is probably a good thing for Europe and the UK, because we learn a lot from that transition. We'll see what works, what didn't work, what lesson to be learned from a technology point of view, but from a process point of view. So it will give a good flavor of what needs to come to the UK and to Europe. But the challenge is different. So if you think in the US, a vast majority of people trading in the US is very US dollar based for US dollar product. So the majority of the volume will stay within the same framework, the same regulation, and the same currency. Where in the UK and in Europe, it's a much more international market, with actors playing in and out from the UK from Europe to the UK, or from the UK to Europe, or other country in the world, from Switzerland, from Asia, and others. So that's the first complexity we'll have to think about, is the international impact that the UK can have versus Europe. The second one that we have is also in terms of scope, trying to define the scope for a UK move to T+1 versus the scope for Europe. In the UK, and here we are focusing more on the bond side, a lot of bonds who are trading in the UK are not settled in the UK, they are settled in Europe, and they are listed on both sides. So you can imagine the challenge if suddenly a bond trade in the UK have to settle T+1, where the same bond will trade T+2 over the pond and settle T+2. So we'll try to avoid those type of divergence within the scope in the UK. And the third dimension of complexity more in Europe than the UK is that the number of CSD that are in Europe. So the complexity from Europe will be even greater than the complexity we have in the UK. And that's why probably Europe will look carefully at all those different challenges and what time is needed for the implementation to happen in Europe versus the UK. The UK, to be honest, is a bit more advanced into the reasoning and the working group and the first report that was published. The Europe is trying to catch up as fast as possible to try, but there is already that realization that scope can be different, than the complexity can be different, And there is the good things, to finish on a good note, there is also the notion that it could make sense for UK, Europe, and Switzerland to go at the same time, to try to align the region like it happened in the US, where you had Canada, Mexico, Argentina, and the US all trying to go at the same time. So if we can do that within this time zone, I think we can limit the challenge. And then the last problematic or challenge that we have between UK and Europe, if they don't go at the same time, is the technical implementation level from the systems that we use on the operation staff. If you think about the US, most of the US back office system are for the US type of business that we do in the US and with system implemented in the US. While for historical reason and good reason, in Europe and in the UK, we share the same back office system for our UK settlement and European settlement. So if we have to diverge or not have the same timing of implementation, that means we may end up with different processes when we settle in the UK versus the processes, the back office processes that we settle in Europe. So that are for me the 4 big challenges that we'll see in the UK and in Europe.
Thank you very much, Stefan. That was a really great overview already. Matt, any thoughts to add from your side with respect to the potential move in the UK and EU to T+1?
I don't think I can beat such a great overview from Stefan. He always does an amazing job. Look, I think the key thing here, and I'll make this more of a statement, I think it's critical that the UK and the EU coordinate in the migration on a move to T+1. Fundamentally, because as all the comments that Stefan made, the interconnectedness of EU and UK financial markets, totally understand, there are separate regulatory regimes now, but they are still in the same investment bucket. You have European ETFs, which operate in credit and also in equities, and there's a lot of dual listings and activity across the different markets. So I think it's critical that there's a harmonization and coordination in that, and we're very fortunate for the UK Task Force and UK Treasury and the FCA to be communicating and talking to the European Union. I think, there's a lot of technicalities that need to come here. I think when we're looking at the move to T+1, critically, there's a number of times where people are going, should we move, should we not? It's happening and moving. So people need to get out of that mindset. This is where it's changing. So the key point that we need to be looking at is also looking at the wider impacts. So we shouldn't be looking insular to our market. We shouldn't just look insular to the EU. We shouldn't look insular to the UK. We should look wider than that. We should look at the impact into Asia. We should look at the impact into the US to make sure that we can catch the different nuances and issues and look at ways to be able to deliver things. I think there's key benefit that T+1 is going to provide is more STP, more automation globally on operational processing of trades, which is going to be a good thing because it will increase efficiencies of data and information share. There are, as Thomas has already said, there's going to be a lot of different frictions that are also going to be created that in the actual trading process. So the key thing is actually trying to pull those two together to look at how we deliver it. And I think from a Europe and a UK perspective, we've got a lot of strong track record in terms of trying to look and solve these issues. And through the likes of ICMA and other trade associations, I think it's really important that we look at that and get around the table quickly on it.
Thank you very much, Matt. Yes, and you mentioned different work streams already and working groups looking at this. So my next question is to Thomas. So from a repo perspective, and maybe based on your last discussions in the ICMA ERCC committee, and also perhaps your work in the UK technical group workstream repo that you are chairing, what are some main topics to look out for on the repo side when you look at a potential move of the UK and EU to T+1?
I think, like I mentioned earlier on, is that there's kind of an approach of, as Matthew was saying, this is going to happen. So we're not discussing whether or not that is the case or not. But at the same time, especially in the UK, government bonds are trading at T+1. The repo market functions on T0. There's some activity on T+1 and T+2 as well from the people who know what they need to do. But that is, it's easier in the UK. Just from a point of view, you're saying we got a network of complex logistics with lots of different nodes, but we have one layer like in the US, right? We got one currency, we got one settlement system, that's it. When you go into Europe, you have multiple layers that you need to solve for at the same time. That is by nature more complex. How much more complex? You can take a subjective view and say super complex, or you can say, no, it's fine. We got target 2, got T2S, and the rest of it. And the CSDs are all fully interoperable, and so are the tri-party agents. But it is just not the same. So, but can we measure it? Can we do a prediction of how bad is it going to get in the first days? No, we cannot. But the UK is different to the US because it kind of sits in the middle for a lot of the reasons that Matt mentioned. So the UK cannot be agnostic to what happens in Europe at any point in time. So it would be in the UK's benefit to have some sort of coordination at some level, at some point in time, in one way or another, rather than saying it doesn't matter, because that would not be intellectually honest either. If you just look at it in terms of mathematical problems of complexity of logistics, that is the reality, right? There are lots of buy sides and sell side which are substituting European collateral across their entities in the UK with US treasuries and with gilts and UK equities and so forth. So it does already happen today. If you start changing that process, it's obvious that something could happen. And again, it's something that needs to be solved for, but I don't think you can just say, well, they can each take their own decision. The gravitational pull is clear, but if you want to optimize the solution and perhaps learn some lessons from others and listen to what happens and map out the interdependencies to get a better decision-making process, the coordination has to be key. I don't think there's anyone that can deny that, despite wills for this or for that, right? Europe has a very complex settlement system. We all know that the ECB has been trying to push it to be more simple, but it is what it is. That's what we have to work with, right?
I think the key thing, and just to add just a couple of things onto that, is we shouldn't just think about this debate as UK, EU. And as Alex and I think Andy said at the beginning as well, we've got Switzerland, which is obviously another neutral state to the conversation, which needs to be considered, and also a number of others. And so there are multiple different jurisdictions that need to be worked through this and to pull together internationally to make this work and make sure it's effective.
Yeah, I think if I may add as well from what Thomas and Matt said, and it's true for the US move as well, is where we know that we are trying to reduce the settlement cycle for different regions of the world, you still may have exemption of where we still need to either go T+2 or T+3 as it is today. And this is a lack of clarity that we need to answer, and those working groups need to answer, right? What is the mandate for should move from T+2 to T+1 versus what is tolerated to stay on T+2 or even T+3 for many different reasons. This is still not clear even in the US, so we have to be careful on that.
Thank you very much, Stefan. So we have gathered now quite a lot of information from our panelists. Thank you already for these great contributions. I can see we have enough time left to maybe now look at some of the questions that were asked by the audience. So one of the questions, for example, that I can maybe answer, will this affect primary market bond transactions? So the correct answer here is probably no, it will not affect primary market bond transactions, not for now at least, unless my panelists have got a different view on this.
Well, I will be a little bit cheeky and say, when you say, will it affect primary markets, do you mean that the move to T+1 directly is going to affect primary markets? We don't know, because we don't know the final text. Is it going to affect primary markets in terms of liquidity based on all the other things that we've talked about? It could.
Yes, I agree. It might have an effect, yeah, maybe if not directly, then perhaps indirectly. That's a good point, Thomas. Thank you very much.
I think possibly the person who asked this question, I don't know who it is, but they are definitely down the rabbit hole. I think there is a couple of live industry discussions in terms of certain transactions being done in primary markets. I'm not going to go down that way because it's just way too much in the weeds. But there are definitely some impact areas which people are currently looking at as questionable points in terms of what's going to happen here and how do we put this transaction through. So that there is, but it's not necessarily the direct primary transaction. There's sort of everything else that hinges off it. But there is some work being done there, I think, in the industry.
Thank you also to Matt. So we will look out for further hints on that side. There's another question, which let me check. Yes. So this is a maybe slightly different question. Do we expect an extension of business hours, especially in back office units, to ensure a timely preparation for settlement on trade day? Not sure whether any of the panelists want to have a go at this question.
I'm more than happy to give it a go, and I'm sure Stefan will chop in a few bits as well. Look, I think the problem is the extending of hours, I think, is not necessarily the answer. Critically, I think you have to map through your transactional life cycle, because I'm aware that there are certain custodians that won't be accepting trades at the US close to actually get stuff sorted out and done. So critically, I don't think the extension of hours is necessarily going to solve things. The globalization, I think, is actually quite important. We've seen people put operations into the US or put operations into other continents to enable a facilitation of trade transactional workflow. There's also questions in terms of where you've seen some people talking about it, saying that we should be extending the trading hours as well, or we should be extending the times of when we can get FX settlements done at the end of day. And critically at the moment, these have generally been answered with a no. I think also overlaying that, we should, and I will put this from a more softer angle, we need to be very mindful about mental health here, because essentially how are we actually going to put this in what the hours that people are going to have to be met. I think we already work pretty long market hours as it is. So there's something that we need to be very mindful there.
Yeah, I fully agree with Matt, and I think it's a valid question because we start to hear that from different parts of the market on the buy side or the sell side to try to say, listen, we'll put more body at it, or we'll try to force the issue by staying longer at night. But to be honest, I don't think it will resolve the issue. As Matt said in the beginning, the only way you can resolve the issue would be through automation of processes and to change of market practice. Because a good example, yes, it's a custodian cutoff will probably stay as is, or will be hard to move, because in something to use example in FX, that at some point you have cutoff of settlement because the system are not open anymore from the central bank point of view or from the CLS point of view. So it's going to be very hard to extend the hours, and there is only 24 hours in the day, right? When you close New York is the start of Asia and then Europe. So it's going to be extremely hard to think that by putting more body at the problem, the problem will go away.
Thank you, Stefan. Indeed, one of the questions or one of the other questions is also, how can new technology help the market meet these demands coming from a shorter settlement cycle? And another question, yes?
Yeah, just to answer that one. I mean, I take a step back and critically, yes, this is there's technology, but the first thing that we need to do is how do we, going back to Stefan's very valid point, how do we put automation into the market? And for a lot of people that know me well, data standards is something quite a strong passion of mine. I'm really interesting dinner speaker, mainly available. But I think the data standards are really critical, and making sure that we can actually put effective data standards to then create STP and then put technology over the top of it. If we create those business standards, those workflows, we then create efficient technology. And I think there's work happening there in the industry, which is really critical to make sure that works.
Yes, and in terms of technology, it's true that a lot of the effort in the past few years have been focused on front office technology automation more than middle and back office technology operation. So this is really going to accelerate that. One way or the other, there are good, interesting tech company who try to automate the settlement process, the allocation process, the confirmation process. And so people should look at that and see how it can help them to accelerate their manual processes and get them fully automated. And then it's going to be a change. Some tech company will also probably start to see how you can adapt those front office processes, right? How can you consolidate that? Now in Asia it exists. You can buy in Asia some securities in different currencies. They are multi-listed in different currencies. So this can help as well to get the two together at the same time. So there is innovative ideas who can be created. Something we didn't speak so far, which is very critical, is to monitor the settlement fails. In a T+2 environment, you still have time to correct your settlement fails. In a T+1 environment, this time is extremely limited. So you want to try to avoid those settlement fails at any cost. And when I say any cost, I mean any cost, because in Europe, you have a fine and penalties if you fail to settle. So it can be extremely expensive when Europe will move to T+1 if those issues about settlement fails are not resolved in a timely manner.
And if I can pick up on the thing with the settlement fails, so just a kind of a case in point is that ICMA have for a very long time been working on settlement efficiency. And just in terms of technology, where the exposures were perhaps need for technology across the board on the settlement side and mostly on the buy side, is that one of the things we discovered when we were looking at solutions to limit settlement fails was doing the same in Europe as they do in the US, which is shape all trades after execution, i.e. blocks of 200 get split into 4 blocks of 50. That is difficult to do uniformly across the board unless you do it exactly at the point of trade, because a lot of people have system where this 200 million trade just gets booked at 200 million. It feeds all the way down to their settlement system and it goes to their custodians, and the custodians are not allowed to do partial settlement. They will have to wait for the full trade to settle. There are loads of incidents like that, not incidents, but there are loads of situations like that where the existing technology stack is just extremely slow and extremely inflexible, because there's a lot of reconciliation. It needs to go through different layers and get reconciled again and gets fed out. And then there's golden source of data, there's embellishment, or there's data lakes. All that complexity will still remain for a long period of time. So if you're thinking, oh, we got a tokenization of assets, we got digital assets, that is going to be the solution to everything. I don't personally think that they're going to be this big bang solution, because we're just changing one set of settlement rails from another one. All the pre-settlement, which is post-trade execution, also needs to be changed somehow across the board with everybody, because we all have very arcane systems for some of these things, some more than others and some layers better than others, but we're all spending a lot of time and energy trying to make those efficient. That still needs to happen. So technology is a solution, but I don't think it will come just like it's there and then the problem is solved.
Thank you very much. And speaking about new technologies and maybe going a step further, and I kind of knew this would come up, one of our market participants has also asked a question about T+0. So there were some very valid challenges outlined about collateral movements and cross dependencies. Would this not create another opportunity for T+1 issuance and trading, particularly on the money market side? Any thoughts on this or on T+0 in general? And this will be my last question for today, because
maybe I can start.
The limit, yes.
It's a valid question, and it was asked in the US by the US regulator, in the UK and in Europe, to try to understand, why don't we just jump from T2 to T0? because if you think about it, you can buy Bitcoin today and you get settled on the same day, almost close to real time, a few minutes later. How come we cannot do that? The problem is it's a complete, to be able to do instant settlement or end of day settlement is a complete change of technology. And as Thomas said, some of our system existed for the last 30 years, and it will take them a huge amount of effort to be able to adapt to T0. So I don't think it's something we are unfortunately going to see in the next 3 years, but it's probably something will evolve slowly in the next 5 to 10 years as the technology start to evolve to a DLT-based technology or in parallel with the existing technology stacks that we have. And in a way, it's like, if you think, it's like when the debit cards replaced the checkbook, right? It took many, many days to settle a check and just a few days to settle the debit card transaction. But the two coexist for some time, and in some country, you still have checks while heavily used on their old system. So I think for T0, that will be a slow progression of adoption of DLT-based tokenization of existing assets, who could, over time, replace the existing stacks that we have. That's a personal point of view.
I've got to slightly contribute to that. I think the key first thing I question is, how do you define T0? Because when you define T0, your mind immediately goes to where Stefan positioned it as DLT, instantaneous settlement. So, yep, that is one part. If you're meaning intraday batches of settlement or a point at settlement on T, I think critically, again, you then need to look at, yes, if you're just doing DVP, as Thomas says, in terms of delivery versus cash, you know, it's a simple trade. Now, I think all of us as market practitioners on this call know that not all trades are DVP, and there are a lot of different other functions in terms of how a trade can be done through different instruments, and also how it can be financed and actually facilitated. So critically, the key thing that we need to look at as a challenge, it's not the technology. DLT's there, totally get that, you can do that. There's a massive cost and a huge uplift to facilitate T0. Question whether it passes a cost-benefit analysis or not, but there is, you know, that's there. The key question is what we then need to do. It's not just mapping an instrument to a trade, it's then mapping the whole transactional process, which might have derivatives or other kind of financing constraints come off from it, and to ensure that that delivery can happen, which I think is exceptionally complicated. And when you dig through it, creates a large number of problems.
Okay, two very good opinions on T0 at the end. And yeah, with that, I think to be continued maybe at another point. But yes, with that, I think we have reached the end of our panel discussion today. And I would like to thank very much our panelists who joined us today for your excellent contributions. And also many thanks to the audience for listening and watching. We hope today's session was interesting and informative to you. And as said earlier, should you have any questions or should you like to get involved a bit more in these discussions, please feel free to reach out to us. As said a few times, of course, T+1 will remain a key topic throughout this year and of course beyond as well. And with the US moving to T+1 in May, we will hold our next T+1 webinar in the summer, where we are planning to speak to different market participants across buy side, sell side, and market infrastructure providers around first lessons learned from the US move. So please look out for further details. We will be in touch on this very soon. So again, thank you all for switching on today, and we hope to see you soon again. Bye for now.